Event after the reporting period, IAS 10. It's a short standard, literally really very short, but it's very important because it is usually given as part of your IAS 38 or IFRS 16 or even IAS 37. So they make it, you don't expect a separate question from here, but you do expect the standard to be somewhere in some other bigger scenario. So the standard says the name is like, events after the reporting period. Okay. So what does that mean? First, I tell you that events after the reporting period, what does that mean? You have got a reporting year, which is, from 1st of Jan to 31st of December, let's suppose. Okay, this is your reporting period. You call it reporting date, or this is your reporting date, and this is your reporting period. You close your books on 31st of December. Now, when you close books on 31st of December, you do not prepare your financials here, because actually until 31st of December, you do not even have the full information. I mean, you are still getting or requiring information. And by the way, who can do closing on 31st of December? In many cases, 31st December is a non-working day. And even if a working day, whatever, on 31st of December, everybody is busy doing more interesting things. Nobody is bothered about financials. So financials, you start working somewhere here. Okay, so you start updating your information. You are collecting more information from your departments. So your sales department is giving, warehouse is giving. So you're collecting information. And then because you have to prepare your annual financial statements, so the finance manager, the CFO, everybody is checking, rechecking. So you are collecting, preparing, reviewing, viewing, editing. Internally, you are doing everything. Once you are sure that I have checked all of my things, you invite your external auditors, because you cannot present financials like this. Shareholders will not take it from you. Your external auditors will come in and they will start reviewing what you have done. So from here, the external auditors start working. And they, as a process or as part of their auditing your financials, they will ask some information from you. And then you will say, okay, I'll give you this information tomorrow. This thing I'll give you in 2 days. They take time, they review, whatever are their audit procedures. And then they finish. And then this is a time period where the accounts are authorized for issue. We call it authorized for issue. So typically under IFRS, there is a 6 months time period. There is a 6 months time period between these 2 dates. If you are closing your books on 31st of December, you must present the financials by 30th of June. You have been given 6 months time period. You have been given 6 months time period to check it, edit it internally, as well as by external auditors. And this is a time which is called authorized date, authorized for issue, where your financials are authorized for issue, which means for presenting to the users. Now, this 6 months time, the business will not stop working. The business continues to operate. The business is working. And it is possible that some events will take place. It is possible that some events will take place which will require me to go back and make changes on 31st of December. That is possible that something happens in February. And this event which took place in February, it forces me to go back on 31st of December and change the income statement and change the balance sheet. These things, we call them, these events, we call them adjusting events. So different type of events will take place. We call them adjusting and we call them non-adjusting. Okay. I mean, whatever, because your operations will not stop. You will keep on buying and selling goods, buying and selling assets, giving credits, recovering money, whatever is happening, whatever is your normal business, you will run it. And this is a 6 months period. So until you have submitted your financials, until this date, we call it events after the reporting date. If you pay attention to the name of the chapter, events after the reporting period. So your reporting period finishes here. After this, the events will take place. And these are 2 types of events, adjusting and non-adjusting. Adjusting events, you change financials on reporting date, which means that it happens in February or March, but you go back on 31st of December and you make changes in income statement and in balance sheet. The non-adjusting events, on the other hand, they do not require you to go back and make changes. So in case of non-adjusting events, we do not make changes here. We just disclose it. Now, what are the adjusting events? Now, you should remember that adjusting event is, it happens in March, and then I go back and I change the numbers. Why do I go back and change the numbers? Because I have still not presented the financials. Financials are still in my hand. So as long as are in my hands, I can make corrections. But once I've submitted the financials, here, there are no adjusting, non-adjusting. Then you cannot go back. You can go back and make changes only during this period. So, and naturally speaking, what type of events are? So we say, what are adjusting events? So you might be thinking that what are the adjusting events? The standard says that adjusting events are those events which provide further evidence, to the conditions existed on the reporting date. So adjusting events are those events which provide further evidence, which means that some evidence was available before. So the word uses further evidence to the conditions existed on the reporting date. on the reporting date, which means that on 31st of December. So this is possible that on this reporting date, there might be some event, there might be some transaction, and then this transaction changes here. You get some additional information about this transaction. I give you an example, very simple example of adjusting events, starting with provision. This is our last topic, which we just did. Provisions are a beautiful example of adjusting events. You know, on 31st of December, we had some court case, we had some lawsuit, which was going on. We didn't know that what is going to be the outcome because it was not decided. It was not decided until 31st of December. So sitting on 31st of December, while on 31st of December, we got an estimate that how much we are expected to be fined, and we thought that we would be penalized by the court for $100K. So we say debit legal expenses, 100K, and we say credit provision, 100K. We create a provision for 100K because it met the 3 criteria. But then what happens that somewhere in this time period, somewhere here in March, the court decision comes in. In the month of March, the court says that you have to pay $110,000. Now, it happened after the reporting date. I prepared financials on 31st December. I booked my expense of 100K and I booked my provision of 100K. And then on, I don't know, 15th of March, the court says that this is the decision. Now, because I have not presented my financials as yet, financials are still in my hand. This is an adjusting event because it is a further evidence. This provides, what is the event? It provides court decision. Does it relate to the past period? Did I have some evidence before? Yes. On 31st of December, we were talking about this provision. On 31st of December, we created this provision. On 31st of December, this issue was in our books. We knew about it. So it's an adjusting event. It is not that which just happened here. It did not start here. It actually started in the last year. So if it is started in the last year and it existed on my books, now additional information, further evidence have come in. What do I do now? On 15th of March, I'm sitting on 15th of March, but I go back to my 31st of December reporting. And I say now, debit, legal expenses, you know, 10K because it is 110. Before I booked only 100K. The court says actual is 110. So I say debit legal expenses 10K. And I say then, you know, debit provision. 100K. This provision which I credited before, I'm going to debit it. I'm removing my provision because there is no more provision. Now it is a case of a liability. Credit, I'm now crediting my liabilities. This provision is something which is uncertain. Now it is being certain. Somebody's mic is on. Safiullah, please mute yourself. So now what you do that from your books, you remove the provision. Whatever you credited before, you debit it now. So provisions are removed. And instead of provision, you record a liability of 110,000. That's now more certain thing. So your, how to say, adjusting events when you speak about, what comes in adjusting events, this is anything which had some evidence from past, anything which started in past. You know, if you have a transaction, let's suppose, I give you an example, further example. Let's suppose that on 31st of December, you had some inventories of 100K. You put it in the balance sheet. And then on 10th of January, there is a fire and inventory is lost. Inventory is lost. See what happened on my balance sheet. I have here, let me just remove something and clear a few things. So here I'm putting my inventory of 100K. On this date, this inventory becomes 0. It is removed. Is it an adjusting event or non-adjusting event? Can somebody tell me? The fire, which has caused. Anybody, please? Should we treat it as adjusting or non-adjusting? Jinesh?
Non-adjusting. Non-adjusting, I think.
Non-adjusting, you think so?
Yes, I think
because we didn't predict the fire.
Yeah, inventory was there, but we never knew that fire could happen. It's a non-adjusting event. That fire is a non-adjusting event because we didn't know that a fire could take place. So fire is a non-adjusting event. But here, please, now I'm telling you one exception. I'm telling you one exception. Remember that fire is non-adjusting. Under normal conditions, fire, which happens after the reporting date, is non-adjusting. But if the fire is so huge, if the fire has caused you such a big loss that your going concern status has come under question mark, your going concern status has come under question mark, which means that the fire has caused a damage of such level that it is causing threat to the existence of the company, then in this case, this fire will become adjusting event. If any event, which is generally classified as a non-adjusting event, and it takes place somewhere here, okay, let me just clear everything. So if this is your period, so you have here non-adjusting events, okay? Non-adjusting events and you have adjusting. So if you have a non-adjusting event here, but the non-adjusting event is of such a scale that it is threatening to the existence of the company, then this event will also be treated as adjusted event and you go and book it there. All right, am I clear?
Yes, sir.
But in normal situations, you had 100K of inventory. This inventory is lost due to fire. So under normal situations, it is a non-adjusting event. Non-adjusting event means that I will not change the numbers here. I will not change the numbers here, but I will make a disclosure note. So I'm not putting it on my income statement as a loss. I'm not decreasing the value of inventory on my balance sheet. I had 1 million of inventory. Out of 1 million, 100,000 is lost. But I'm not showing this 100,000 loss in the balance sheet. On the balance sheet, I'm still saying it is 1 million. But then I put it as a disclosure note so that the shareholders, to tell them that, see, on my balance sheet, I've shown you inventory valued 1 million, but actually we don't have 1 million anymore. We don't have 1 million anymore because some of that is lost. So I did not change it in the balance sheet, but I'm telling you through disclosure note, this additional information, so that you do not go to the warehouse and start looking for where is my inventory. So please be informed. I'm not putting it in the financials because it is non-adjusting, but I'm telling you through disclosure notes. Am I clear on that? Now, we say that events after the reporting period are those events, both favorable and unfavorable. It could be favorable, could be unfavorable, that occur between the end of the reporting date, end of the reporting period, and the date when the financial statements are authorized for issue. So between these 2 dates, because once you have issued, then you cannot change. Remember. So this is your period. Here you have authorized for issue. Now, after this thing, if something will happen, then you cannot go back. Because once financials have been given, you cannot change. You can only make changes in the financials until you have not submitted them. There are 2 types of events, adjusting events and non-adjusting events. Adjusting events are those, they provide evidence, I would say further evidence of conditions which existed at the end of the reporting period. Non-adjusting events, these relate to conditions which arose after the reporting period. And by the way, if you have this, okay, somebody's mic is turned on, please mute yourself. I think it is safe enough. So if you are actually, opening some new business here or closing some new business here, these are non-adjusting events because these are the normal business occurrences. They are not related to the past period. So these are considered as non-adjusting events. Okay, adjusting events, examples of adjusting events include insolvency of a customer with balance owing at the reporting period. So if you have on your balance sheet some receivable and that customer goes bankrupt, it's an adjusting event. Sale of inventory after the reporting date for less than its carrying value. Yeah, that's an important event because on this particular date, you have valued your inventory for 10,000 and then you sell it here for 9,000. So this is an adjusting event because it means that the value here is overstated. So you need to go back and decrease the value of the inventory. Whenever you sell value lower than the book value, it means that you overstated it before. So you make a correction there. These are adjusting events. Evidence of an impairment of a non-current asset prior to the end of the reporting period. Impairment prior to the end of the reporting period. Evidence. The outcome of a legal case which was provided for at the reporting date. Like I explained to you that you created a provision. When I say which was provided for, it means that you created a provision for that on 31st December. And later on, you got the court decision. Discovery of a fraud or error which shows that the financial statements were incorrect. Yeah, that's possible. You might have made some error or there was a fraud which was revealed, but revealed between the 2 periods. After authorization, you cannot do anything. Before authorization, you can do. The financial statement should be amended to include the effect of adjusting events. This is likely to require the recognition of a loss in profit or loss. Non-adjusting events, examples of non-adjusting events include announcement of a plan to discontinue an operation. So if you make discontinue some plan, this is non-adjusting event. If it happens in January, February, March, it has got nothing to do with the last year. Share transactions after the reporting period, you issue some shares, buys back some shares. Major purchases and disposal of assets. These are all non-adjusting events because these are your normal course of operations. And there is no evidence from the past. If there is an evidence from past, then you do it. Litigation commenced after the reporting period. For example, you know what? This is the court case again. But here, what happened? We said that we had court case here and we provided for here. Let's suppose that there is no provision here. The court case started here. So this is now non-adjusting because on 31st December, there was no evidence of this thing. You need to see that, is this transaction somehow related to there? Is it coming back from the previous period? This was not coming back because it started after the reporting date. So now this type of court cases are non-adjusting events. The acquisition or disposal of a subsidiary after the reporting date. You acquired some business, dispose of some business, non-adjusting events. So these are the examples. Non-adjusting events, the nature of event and an estimate of the financial effect is disclosed. I told you that the non-adjusting event can be converted to adjusting event if it threatens the existence of a business, okay? If a non-adjusting event, it becomes of such a big size and scale that it causes the existence of the business under threat, then this becomes adjusting event. Okay, that's all with this chapter. A short chapter, not really very long. But you might be getting some questions because they provide you some information that, company purchased this thing or sold this thing, made some loss, made some gain, and then it happened in that particular day, customer has gone bankrupt. So sometimes, and it is very common that they give it an exam. So you just need to decide that, okay, this is a loss, it is happening in January. Should I take a factor in December or not? Should I take it under my treat it under adjusting event or unadjusting event? And it's very, how to say, popular theme in exam. It might not come for bigger marks, maybe 2-3 marks adjustment, but it very frequently appears.